Welcome to the Deep Dive. Today we're tackling something major. Federal Reserve Chair Jerome Powell's final Jackson Hole speech back on August 22nd, 2025. This wasn't just, another policy update. It felt like a real dovish pivot.
Absolutely. A clear signal they're shifting gears, perhaps leaning towards a rate cut in September, maybe even the start of an easing cycle.
Exactly. So we're going to cut through the Fed speak and figure out why. Why this sudden pivot from fighting inflation hammer and tongs to, worrying about the job market.
It's a critical shift.
Our mission today, really grasp this moment and what it might mean for you heading into 2026. Okay, let's unpack this. Powell's his final Jackson Hole address. Pretty significant moment for his legacy, right?
Definitely. And the theme, labor markets in transition, that wasn't accidental.
No, it provided the perfect academic cover, almost, for shifting focus from inflation to potential weaknesses in employment.
You could see it as a very strategic communication move. It helps justify the policy change on economic grounds, especially with, all the political noise pushing for cuts. Defends their independence, you see.
But does it really insulate them? Couldn't critics just say, look, they're just finding an economic excuse for what politics wanted anyway? How do they counter that perception?
That's always the tightrope they walk.
Yeah.
And the language, I think, is their main defense. It was fascinating how precise it was, calling the labor market a curious kind of balance. It's skillfully done, avoids panic, but hints there's real concern underneath.
A fragile balance.
Exactly, fragile. And they linked it to things like tighter immigration policies, meaning slower hiring is happening, but so is slower growth in the number of people looking for work. It masks the weakness.
So what was the smoking gun? The actual signal?
It was a line, the shifting balance of risks may warrant adjusting our policy stance. That's Fed code for we're changing how we react to data. It basically locked in the expectation of a September cut.
Okay, but inflation's still sticky. How do they square cutting rates with that? Especially with tariffs maybe pushing prices up.
Right. Powell addressed that by calling the tariff impacts a one-time shift in the price level. Kind of technical, but it means they see it as a temporary bump, not something that'll trigger ongoing inflation like a wage price spiral.
Especially if the job market is softening anyway.
Precisely. Less risk of wages chasing prices if hiring is slowing down, so they feel they can look through that tariff effect.
A curious balance indeed. It sounds precarious. And the trigger for all this urgency seems to be the labor market data itself. It really fell off, didn't it?
Dramatically. Payroll growth averaged just 35,000 a month over the last 3 months. That's barely moving. And lots of downward revisions to previous months, too.
And Powell warned about that downside risk materializing quickly. That Wile E. Coyote moment fear, right? Where you suddenly realize you've run off the cliff.
Exactly. That fear compels preemptive action, an insurance cut, essentially. They're trying to cushion the economy from a downturn partly caused by, other policies on trade and immigration.
Even with core PCE, inflation's still hovering around 2.9%. That's the tough part.
It is. They're making a difficult trade-off.
So the Fed sees danger ahead for jobs. How did the markets take this rather complex news? You know how they can be.
Well, it was pretty much a classic knee-jerk celebratory reaction.
The pivot party.
You got it. Equities surged. Dow up 850 points, S&P 1.6%, NASDAQ almost 2%.
Wow. And bonds.
Yields fell sharply. The 2-year Treasury, which is really sensitive to Fed policy, dropped about 10 basis points down to 3.69%. The dollar weakened. The VIX, the fear gauge, just plummeted over 12%.
So the market heard rate cuts and ignored because the economy might be weakening part?
Largely, yes. That's the Fed put trade in action. Investors believe the Fed will step in, so they buy assets, focusing on the easy money policy and looking past the weaker data that justifies the cuts.
But isn't that a dangerous game? Relying on the Fed put, does it just encourage more risk-taking, knowing there's a safety net?
That's the perennial debate. Moral hazard, yes, it's a risk. The rally's durability really depends on the market continuing to look past the economic weakness.
Okay, so looking ahead then, what does this pivot really mean as we head towards 2026? It feels like a strategic shift, not just a tactical one.
I think that's right. The Fed's framework for 2025 seems more pragmatic now, more of a long-term dovish tilt, signaling they're willing to let inflation run a bit hot temporarily to keep the labor market strong.
And what does that environment look like?
We're probably looking at something like a stagflation-light scenario through 2026.
Stagflation-light, so not the 70s nightmare. But...
Right. More like sluggish growth, maybe 1.3 to 2.0% real GDP. Inflation, especially core PCE, stays stubbornly above 2% for most of the year. and unemployment drifts higher, maybe towards 4.5 or even 5.0%.
Okay, so slow growth, sticky inflation. What about equities in that kind of environment? You mentioned a tug of war.
Exactly. Lower interest rates provide some support for valuations. You could plausibly see the S&P 500 heading towards, say, 7,000 or 7,500 by the end of 2026. But that slow growth will put pressure on company earnings. It's a push and pull.
And within that tug of war, you mentioned a strategic imperative, the great broadening. What does that involve? Why rotate now?
Well, the dominance of just a few mega-cap growth stocks can't last forever, especially if growth slows. The great broadening means looking beyond those names. So for investors, it suggests maybe increasing allocation to small-cap stocks, shifting towards value and more cyclical sectors, think industrials, materials, financials. Maintaining quality is still important, though.
And internationally.
Yes, enhancing international diversification makes sense, especially if the dollar continues to weaken as the Fed eases. For fixed income, bonds favoring intermediate duration seems prudent, balancing risk and return.
Okay, so the big picture. This pivot basically reinstates the Fed put. The Fed will act if things get rough. A deep recession might be less likely, even if a mild one is still possible. And that justifies maybe higher baseline values for stocks long term.
That's a reasonable interpretation, yes. Reduced tail risk, you could say.
Got it. So wrapping up with the Fed now...